Most traders are using the wrong time frame, and it's quietly destroying their progress. In this video, I'm going to explain what Forex trading really is, and why I personally stopped relying on long time frames and started focusing on shorter ones. Let's start from the beginning. Forex trading, also known as foreign exchange trading, is simply the process of buying and selling currencies to make a profit. For example, when you see a pair like EUR/USD, it means you are comparing the euro to the US dollar. If you believe the euro is going to become stronger than the dollar, you buy. If you believe it's going to become weaker, you sell. That's it. The goal is to predict whether price will go up or down and make money from that movement. Now, the market is always moving. Prices are changing every second, and this is where time frames come in. A time frame simply shows how much time each candle represents on a chart. So on a 1-minute time frame, each candle represents 1 minute. On a 5-minute time frame, each candle represents 5 minutes. On a 1-hour time frame, each candle represents 1 hour. Depending on the time frame you choose, the chart will look completely different. Some traders prefer long time frames like 1 hour, 4 hours, or even daily charts. Others prefer short time frames like 1 minute, 5 minutes, or 15 minutes. But the real question is, which one is better? Let's talk about long time frames first. Long time frames include things like the 1 hour, 4 hour, and daily charts. The main advantage is that they are slower and less noisy. You don't need to sit and watch the chart all the time, and trades take longer to play out. But here's the downside. You might wait hours or even days just to take one trade. And for beginners, this can be frustrating. You're just sitting there, waiting, and not really learning much. Yes, long time frames can be powerful, but they require a lot of patience and discipline. Now let's talk about short time frames. And this is where things change. Short time frames include the 1 minute, 5-minute, and 15-minute charts. These move much faster, and because they move faster, you get more opportunities to trade, you get quicker results, and you gain more experience in a shorter amount of time. Instead of waiting all day for one trade, you can take multiple trades in a single session. And for me personally, this made a huge difference. I was able to learn faster, I was able to understand the market better, and I became more active instead of just waiting around. Now, I'm not saying short time frames are easy. They are actually more intense. You need focus, you need discipline, and you need proper risk management. But if you're someone who likes fast-paced action, if you want to improve quickly, short time frames can be very powerful. So why do I personally prefer short time frames? First, I don't like waiting all day for one trade. I prefer being active. Second, I learn faster. The more trades I take, the more experience I gain. And third, I can adapt quickly. If something goes wrong, I don't have to wait hours to fix it. But let me be clear, short time frames are not magic. If you don't have discipline, you can lose money faster too. That's why it's important to manage your risk, stay patient, and avoid overtrading. This is not gambling, this is skill, and skill takes time to build. Also, Forex trading itself is risky. You can make money, but you can also lose money. So don't just jump into short time frames thinking it's easy. Take your time to learn, practice, understand the market, and never risk money you can't afford to lose. At the end of the day, there is no perfect time frame. It depends on your personality and your style. But if you prefer fast-paced trading, learning quickly, and staying active, then short time frames might be exactly what you need. Frames, let's go deeper, because one of the biggest questions beginners ask is this: who actually controls the Forex market? Is there someone behind the scenes moving the price, or is it just random? The truth is, the Forex market is not controlled by one person. It's controlled by multiple powerful players interacting at the same time. Let's break this down. At the top of the market, you have central banks. These are institutions like the Federal Reserve, the European Central Bank, and others. These banks control interest rates and money supply. When they make decisions like increasing interest rates, it can cause massive movements in the market. For example, if a country raises interest rates, its currency often becomes stronger. Why? Because investors want to put their money in that country to earn higher returns. So central banks are one of the biggest forces behind price movement. Next, you have big institutions. These include banks, hedge funds, and financial companies. They are trading millions. sometimes billions of dollars every single day. When they enter the market, they create strong movements. This is why sometimes you see price suddenly shoot up or drop fast. It's not random. It's big money entering or leaving the market. Then you have governments and economic news. Things like inflation, employment rates, GDP reports. All of these affect currency strength. When news comes out, the market reacts instantly. And finally, you have retail traders. That's people like me and you. But here's the truth. Retail traders don't move the market. We are too small. Instead, we react to what the big players are doing. So when you're trading, you're not fighting the market. You're trying to understand what the big players are doing and follow their direction. Now, this is where it gets interesting. A lot of beginners think the market is manipulated against them, and sometimes it can feel that way. But in reality, what's happening is this. Big institutions are looking for liquidity. They need buyers and sellers to enter and exit their trades. So price often moves to areas where a lot of traders have placed their stop losses. That's why you might see price go up, hit your stop loss, then reverse. It's not personal. It's just how the market works. Now, understanding this changes how you see trading. You stop thinking emotionally, and you start thinking strategically. Now, let's talk about something a lot of people are curious about. Can you actually become rich from Forex trading? The answer is yes, but it's not easy, and most people don't make it. But there are some traders who have made massive amounts of money. One of the most famous is George Soros. He is known for making over $1 billion in a single day by betting against the British pound. This event is often called Black Wednesday. What he did was identify weakness in the currency and took a huge position. And when the market moved, he made history. Another well-known trader is Stanley Druckenmiller. He worked alongside George Soros and was also involved in that massive trade. He is known for having one of the best long-term trading records. Then you have traders like Paul Tudor Jones. He built his wealth by understanding market trends and making smart, calculated decisions. These traders didn't rely on luck. They relied on discipline, risk management, deep understanding of the market. But here's something important. They didn't start with millions. They built their way up over time. And that's where most beginners get it wrong. They come into Forex thinking, I want to get rich fast. But the reality is, Forex is a skill, and like any skill, it takes time to develop. Now, bringing this back to timeframes, why do short timeframes actually help beginners? Because they give you more exposure to the market. You see more setups, you experience more wins and losses, and you learn faster. But again, this only works if you stay disciplined, because the same thing that helps you grow faster can also make you lose faster. That's why risk management is everything. Always remember, protect your capital, don't overtrade, don't chase losses, and most importantly, don't compare yourself to professional traders too early. Focus on improving step by step, because at the end of the day, the goal is not just to make money. The goal is to become a consistent trader, and consistency comes from practice patience and learning from your mistakes. So now you understand what Forex trading is, who actually moves the market, and why short time frames can help you grow faster. This is Corporate Cat.